Mic check. 1, 2. If you can hear me, stay locked in, because what I'm about to explain is the kind of market event that flips narratives overnight. Here's what just happened. While much of the Western market was busy arguing over whether silver had already peaked, silver in Asia printed above $100. Not 90, not almost, but decisively above 100. At the exact same time, the paper market in New York went into overdrive, throwing everything it could at the price to push it back down. That gap, that divergence, is the real story. That's what this entire discussion is about. The real question now is whether we are watching a controlled burn or the first visible crack in the dam. I'm John A.G., and today I'm going to walk you through what is happening in silver right now, why the futures market is behaving like it's under stress, how extreme the paper volume has become, why Asia is paying a premium that makes no sense on paper, and what the next few trading sessions could look like as options roll off and the usual games intensify. Before we go any further, a quick favor. If you want more direct, no-nonsense commentary on metals, hit subscribe. It's quick, it's simple, and it helps this channel stay loud. Let's start where every honest analysis should begin. Price action. Price is the language markets speak when headlines are lying. Over the past 48 hours, silver surged to fresh highs in the low 93s, then was slammed hard into the mid to high 80s. This was not a gentle pullback. It was a punch. But like a fighter who wasn't knocked out, the market stood back up and began climbing again. The key detail isn't the dip itself. The key detail is that the market refused to stay down. If you focus only on 5-minute candles, it looks chaotic. If you zoom out, it looks like a market trying to rise while someone keeps pressing down on its head. What most people miss is that these attacks are not random. The timing tells you exactly who is leaning on the scale. When the futures market pauses briefly each day and then reopens, you often see where price wants to print naturally. The moment trading resumes, you'll see a sudden jump, a gap, or an immediate shove, like a compressed spring being released and then forced back down. In the last session, silver reopened with a noticeable jump, quickly filled the gap, drifted, and then was hit again. That is not organic price discovery. That is pressure management. What makes this different from all the other times silver has been slapped down comes down to two things: volume and the east-west spread. Let's talk about volume first, because this is where the situation becomes absurd. In the past, a normal day in silver futures meant 60 to 80,000 contracts changing hands. Each contract represents 5,000 ounces, so even then, hundreds of millions of paper ounces were trading daily in a market where physical supply was already tight enough to keep premiums elevated. Now fast forward to recent sessions. We are seeing multiple days where paper trading approaches, touches, or even exceeds the equivalent of 1 billion ounces in a single day. 1 billion paper ounces. And this isn't a one-off anomaly. It's clustering around the same price zones, the same round numbers, the same areas where silver keeps getting pinned. You don't need to be a conspiracy theorist to understand what that implies. When paper volume explodes precisely as price tries to break higher, that's not a debate. That's a fight. For anyone new to this, let me translate what that means in practical terms. Massive paper volume can be used to manufacture short-term price moves that have little to do with real physical supply and demand. It's like shouting louder than everyone else in the room. You can drown out the truth temporarily, but you cannot erase it forever. Now let's talk about the second piece, the east-west spread. While futures pricing in New York has hovered in the low 90s, Asia has been printing triple-digit prices, over $100 per ounce. That matters because a premium of that size is an open invitation for arbitrage. If metal can be bought cheaper in one region and sold for significantly more in another, physical silver moves. And when physical silver moves at scale, it doesn't just shift inventory, it shifts leverage and power. If you are a large player with access to physical supply, you do not ignore a $10 per ounce difference. You load the shipment. You book the container. You move the metal. And when that happens, the physical pool supporting paper promises in the West quietly drains. One of the cleanest signals of physical stress is backwardation, when spot prices exceed futures prices. It sounds complex, but it's simple. It means buyers are willing to pay more to get metal now than to get it later. Silver has been flirting with backwardation on and off. That's not a curiosity. That's a warning light. When now becomes more expensive than later, it tells you supply is tight, and tight supply is the enemy of a leveraged paper system. This is where emotional whiplash sets in for many people. On one side, you have the mainstream narrative. Silver is volatile. Silver is dangerous. Silver has topped. Silver is about to crash. On the other side, you have the data. Record paper volume, Asia paying double-digit premiums, physical retail prices climbing, backwardation signals flashing, and a market that refuses to collapse. Those two stories do not match. When stories don't match, one is narrative and one is reality. Adding to the tension, we're heading into an options expiration window. These periods often bring strange behavior. Sudden spikes, abrupt drops, and magnetic price action toward certain strikes. If there's a long weekend or holiday nearby, liquidity gets thinner and positioning becomes more defensive. Traders hedge, roll, dump, squeeze, and do whatever they need to do to manage risk. If you're expecting a smooth, polite climb toward $100, that's not how this usually plays out. The path to a major round number is almost always messy, uncomfortable, and full of traps. The harder the defense becomes, the more important that level is. There's a very clear reason for that defense. Below $100, most people shrug. Above $100, people pay attention. Once attention arrives, demand often follows. That's when a tight physical market can become unmanageable. The incentive to cap price isn't about hating silver. It's about preventing awareness. Gold reinforces this picture. Gold has been holding at elevated levels north of $4,600, even through volatility. That matters because gold reflects confidence in currency. When gold stays high, it signals that purchasing power is eroding. When currencies bleed, hard assets attract capital. If gold is holding and silver is coiling, the next move in silver has the potential to be violent, though not necessarily in a straight line. High retention markets punish impatience and reward discipline. Here's how to watch the next sessions without losing your head. Watch the spread between Asian pricing and Western pricing. If the premium remains, physical demand is still pulling metal east. Watch for backwardation signals. Watch paper volume spikes at key levels. Exploding volume during price suppression is information. Watch retail premiums and availability. If you can't buy real metal without paying 10, 15, or 20% over spot, the paper number isn't telling the full story. You're going to hear claims that silver has crashed. This happens every time silver pulls back after making a new high. Notice the framing. They don't say silver hits records. They say silver plunges. That language is intentional. Here's how you stay grounded. Compare the pullback price to where silver was days or weeks earlier. If a so-called crash lands you near prior records, that's not a crash. That's a battle line. The irony is that prices once considered unbelievable are now treated as failures if they don't keep rising hourly. That's how you know sentiment has shifted. Each silver futures contract represents 5,000 ounces. When daily volume reaches 200,000 contracts, that's 1 billion paper ounces changing hands. That metal is not moving. Those are claims, leverage, and promises. Paper is flexible. Physical is stubborn. Paper can be created and unwound instantly. Physical must be mined, refined, shipped, and delivered. When physical tightens, paper gets louder. Eventually, the signal leaks through. Ask yourself whether this premium is temporary or the start of a real repricing. That answer defines how you see this market. And if silver tags $100 again, ask yourself whether the headline will read New Era or Bubble. The framing tells you everything. What do you actually do with this information? First, stop letting intraday smackdowns control your emotions. Volatility is a tool used to shake conviction. Second, Don't build a plan that requires perfect timing. Markets like this humiliate perfection. Third, focus on real-world clues. Premiums, availability, delivery delays, procurement demand, and cross-market spreads. People often dismiss Asian premiums as taxes or policy effects. Even if policy plays a role, a persistent premium still reflects willingness to pay. Willingness pulls supply. Some regional retail quotes suggest all-in prices far above futures benchmarks. If even part of that is true, it's not a small signal. It's a siren. The paper market can still push prices down because it's built for leverage and timing. Options expirations, margin adjustments, and high-frequency flows can engineer short-term moves that look like sentiment shifts but are really positioning games. The difference between a paper-driven dip and a real demand collapse is visible in the physical market. Right now, physical urgency remains. Floors are discovered through violence. The market probes, tests, and fails or succeeds. What we can observe is that silver keeps finding buyers quickly in the high 80s and low 90s. That doesn't mean it can't dip again. It means each dip must be judged by what happens in the physical market afterward. Watch the broader financial plumbing as well. Stress in funding markets can force selling across assets, creating strange correlations. Sometimes metals move not because the thesis changed, but because someone needed cash. At its core, this is the picture. Silver, one of the most important industrial metals for electrification, is trading at wildly different prices depending on geography. The West relies on a benchmark shaped by massive paper volume. The East is bidding for delivery. That spread creates metal flows, and metal flows change leverage over time. Even when spot trades below $100, many people are already paying over $100 in the real world. The consumer experience often arrives before the headline. Markets don't move straight up when there is strong incentive to stop them. Tight markets often look chaotic, not euphoric. Manipulation delays moves. It doesn't prevent them. Targets are not predictions, but round numbers are magnets in battle zones. If silver breaks 100, expect chaos. If it holds above 100, expect the narrative to flip without apology. Watch the weekly and monthly charts. A crash is a structural failure, not a temporary stumble at elevated levels. Margin hikes and policy changes often appear when momentum builds. They flush leverage, not necessarily conviction. If the premium keeps returning after each dip, that's habit, not coincidence. Silver doesn't exist in isolation. In an environment of currency debasement and commodity repricing, its behavior makes sense. It is pulled by monetary demand and industrial demand at the same time. Above $100, silver becomes a story, not just a quote. Stories attract attention. Attention attracts capital. That's why the market fights hardest right before those moments. Today, watch the behavior, not the noise. Watch how quickly dips are bought, whether premiums persist, whether volume aligns with suppression, and whether the market closes strong despite repeated attacks. Ask yourself whether the defenders truly won or merely delayed the move. If the West fails to keep silver capped below $100, the narrative machine will flip, just as it always does. It won't apologize to the people it scared out. It will pretend it was obvious all along. Stay sharp, stay calm, and focus on what the market is actually doing, not what the loudest voices are shouting. I'm John A.G. Drop your answers below. Temporary or repricing, new era or bubble. I'll be reading them, and I'll see you in the next one.